Thank you very much. And good to be talking with you all today. My name is Eric Hansen. I'm a partner in the corporate practice at Wilmer Hale. Um, first let me just kind of lead off by saying, since we have a pretty manageable group, do feel free to send through any questions or anything through the chat. Today I'm going to be talking a little bit about founder equity, and hopefully get you a taste of what some of the issues that we deal with our startup clients as we get them off the ground. Let me just share my screen here. Hang on a second. All right. So like I said, we're going to talk about founder equity. I work a lot with startup companies, from the earliest stages forward. And so, one of the most important things that you have to deal with at the front end of a company's growth cycle is how do you get the company off and running. There's a lot that you need to do that you need to get right as a starting point. If you get it right, it makes things tremendously easier going forward. And so we always want to make sure that you get going in the right way and in a way that sort of meets expectations of the folks that you work with. So here's what we're going to be talking about today. Just a quick little agenda of today's presentation. What does it mean to be a founder? How do you allocate? Some of the typical terms of founder agreements, vesting and acceleration, which are important. And then sort of, I'll close the founder equity piece just to talk about, meeting expectations. That's a big part of the theme running throughout here. And then we'll also talk about seed financing and some of the things you need to think about there, time permitting. So what does it mean to be a founder? A lot of people come to us and they say, well, here's, I'm the CEO and I have, 8 other people with me. Is this person a founder? Is that person a founder? It's really a sort of case by case determination, and it really depends on the types of companies that we work with. I would say, really from my perspective, there's no legal significance to the title founder. So you could call anyone a founder. The trick is that, when you get in conversations with investors and others, folks are going to want to meet the founders. And so you want to have a sort of manageable set of people who you consider the founders, and you want to ensure that they're compensated fairly for that. So a few common things that we see that are mistakes here is, you may have a team of 8 or whatever, and it's not always the case that you want everyone to be called a founder. You might only pick a couple people who are the founders, and then you have others who are sort of the next tier down, and the equity is going to sort of match up with that. Another mistake that we see that's real common is getting to an understanding early about if you're going to be a founder, that's a big commitment. And the expectation, what are the expectations in terms of responsibilities, who does what, and how you allocate roles within the business. That's really important at the earliest stages. Another thing we see commonly, not only at the earliest stages, but throughout, is lack of clarity on getting the documents signed, and so you want to make sure that everyone who is a founder or who is an early contributor to the IP, the intellectual property of the business, is signing intellectual property assignment agreements. That's an important part of ensuring that everything works out. And then just sort of making sure that your personalities match up and you feel like you can get through thick and thin. through the journey, because it's a long process to go from formation to funding and then to exit. So here's a little, we have a survey that we run on occasion. What are the roles of the founder? Often I would say the founders are the CEO, the head of the sort of technology side of the house, and then maybe sort of a COO role or catch-all role. But those are the critical components of a founding team. Your CFO, your head of sales, engineering, whatever. Those folks tend to be sort of your next tier of hires, and you see that on this chart. So how are the founders compensated? This is, of course, a critical component of thinking about incentivizing and keeping folks at the company and motivated to continue. So in terms of the founder compensation, usually the way that we do the compensation for founders is a combination of cash and stock. What I would say is that you find more often with the founders, their compensation is going to skew more toward stock than it is toward cash. So what that means is you're going to be eating ramen at the earliest stages, and that happens for a while as the company grows. And it does, I would say, as the company grows and progresses through its growth cycles, after your Series A financing and then as it grows, you'll be able to see more cash compensation for the founders. But there are some famous examples of companies where the CEO hasn't received more than $1 in actual salary compensation, and the rest comes through selling stock or whatever. And so that's not uncommon. Although I would say you should feel free to pay yourselves so you can make this sustainable. So how do you think about allocating the founder equity? So I usually sort of walk our founders through some of the math here on this slide. And what I would typically say is the math usually just works out best if we authorize about 10 million shares of common stock. And for whatever reason, that seems to be quite common at the earliest stages. And then out of that 10 million shares of authorized stock, you would then take the shares and you would divide it out as among the founders. Usually 5 to 6 million shares go to each of the go in total to the founding team. And so then you'll break that out as among the founders, and you usually pay a nominal price per share on the founding shares. Beyond that, you usually allocate about 10 to 20% of the authorized shares to an equity incentive plan, and that's sort of what you hold in a reserve to be granted to the future hires by the company. And so that, think of that as sort of your bank account for future equity. Of course, equity is, as valuable as cash at the earliest stages. And frankly is, you're going to have in greater amounts than you will have in cash at the earliest stages as well. You might also want to think about, do you want to allocate all the shares up front or set aside some shares for later? A lot of folks that I have conversations with tend to ask me, okay, we'll allocate 6 million shares, but I have a co-founder, who's going to come in sort of at an equal level, and I want to give them an equal amount of shares at the time that they join.
And so, for a co-founder like that, who, maybe coming on board 6 months or a year later, you do need to sort of set aside some shares you can issue down the road. So sometimes we do set aside additional shares for, co-founders, or if you're collaborating with a big company, you might want to set aside some shares that you can use for those collaborations. And so all that goes into the mix. It's worth noting that you can change the number of authorized shares. So we do that in connection with your financing rounds. Um, but it is rare, and it requires a filing with the state of Delaware, which is, a non-zero expense. So I would say, you want to get everything right at the starting point, and you don't want to be in a situation where you're doing a lot of changing as you go on the equity. So how do we think about allocating among founders? I think the key thing to think about is, it's not always automatic, and you can't just say, okay, there are 3 founders, so we're going to split it equally as among the 3 of us. You really have to be thoughtful about who's joining the team, how they're making contributions to the team, what their role is going to be going forward, and what they've brought to the table up to now. So you might have, some founders or some early employees are going to contribute the equity right away, but maybe they have another job, and so they can't spend a lot of time, helping you out going from the formation stage to going forward. And so you probably give them a little bit less equity if they're not going to be a full-time contributor. You might have someone who is more of a, your technical folks. If somebody's contributing, critical technology, or they have the knowledge of the technology that is necessary for the company's success, it may be the case that those folks get compensated better in terms of equity than other folks on the team. On the flip side, if it's someone who's, serving a capacity that frankly could be filled by someone else, maybe you don't give them as much equity, because you could easily hire a substitute person in the market. So we, because all of this is sort of a tricky thing to figure out, we've actually worked with some folks to put together like a founder equity calculator. So if you go to our website, launch.wilmerhale.com, that has a pretty good device for calculating, what founder equity should look like. And it can kind of tell you, okay, well, if you're a CEO and you're non-technical, and maybe you don't have a lot of experience, that you may be in a weaker position versus someone who has, more technical value to contribute, or more experience, and maybe you will be compensated in a lower proportion for that, as opposed to those who have more experience or more technology to bring to bear. But it's a useful starting point to think about things, and then often teams need to just sit down and sort of figure out what works for them as they go forward. Okay. So once you've decided on how to basically slice the pie of founder equity, then you've got to enter into founder agreements that sort of cover the ownership of the shares. And over the next few slides, I'll sort of walk you through what some of the typical terms are here, and hopefully give you a sense for what to expect. Because a lot of these things I think of as typical terms are somewhat of a surprise to folks that we work with, and so it's just useful to sort of know what there is. So first, it's important to know that when you receive your shares, when you buy your shares at founding, the shares are generally going to be subject to what's called vesting, meaning you receive the shares, but you don't fully own them until you stay at the company for some period of time. successfully contribute the work that you intend to contribute from the outset. So that's an important thing that you need to get right at the start. And then sometimes there are protections you can build in for the founders that will accelerate that vesting schedule on certain conditions. We'll get into that in a little bit. Some of the other terms that you see quite commonly, company right of first refusal. Usually, a lot of the startups we work with, they want to have really good control over who owns shares in the company, so that they, know they don't have any rebels on the cap table or anyone who's gonna cause trouble for the company. And so for that reason, the company usually has the right to purchase stock from the founder if the founder is looking to sell some of their vested shares. So if the founder tries to sell, the company usually has the right to buy those shares first, and that's both common, but it's also, puts a significant constraint on the ability to sell those shares over time. And then just know that it's broad at the outset, but it gets even broader at the time an investment is made, because the investors sort of have the same interest in ensuring that everyone has skin in the game and is continuing to work for the company. The next point is called a lockup, and it basically, what that says is if you take the company public, you're not allowed to sell your shares for a specified period after the IPO or after another public offering. It's typically 180 days, and you'll see that everywhere, but it's a lot of text in these agreements, and so we get a lot of questions about those. This is totally common. You have it in every agreement. And then the final thing I would say we have in some founder agreements is, some sort of voting arrangement or agreement as among the founders. Let's say you have 4 or 5 founders, and they're all, they all may be coming from different points of influence. You may want to decide as amongst the founders who's going to sit on the board of directors, because whoever sits on the board of directors has a pretty significant amount of influence over the business going forward. So you might have a voting agreement for that. So vesting, I mentioned that earlier. So vesting, basically what it says is you're going to get the shares unvested, and then the company has the right to purchase your unvested shares if you happen to leave the company at any point in time. And you vest over time. And the goal here is that you want to keep everyone sort of aligned from an incentives perspective, and make sure that everyone's sort of rowing in the same direction, and the equity reflects the business at any snapshot in time. And by setting up vesting, basically what that means is that if you leave early, then you're only going to keep your vested shares, and you're going to have fewer shares over time, as a proportion of all the shares that are outstanding in the future. Vesting is very important to investors, so expect that investors are going to scrutinize this closely. And then I would say, to get to the meeting expectations point that I made earlier, the typical Valley standard vesting schedule is a 4-year vesting schedule from the first date of employment. So if you're a founder, you start the company, basically what that means is that you're expected to stick around for 4 years if you want to own 100% of your shares. There's what's called a cliff at the 1-year anniversary. What that means is you get 25% of your shares vest 1 year after your start date. And then over the following 3 years, there's usually sort of periodic vesting, either monthly or quarterly. The thinking there where you're hiring someone, you don't know if you're going to keep them around for the long term, and by having a 1-year cliff, that allows you to sort of evaluate their performance before you commit to having them on the cap table. Sometimes you do have some variations. You might have someone who worked on a project, or maybe it was they were a grad student, 3 years on a project that was the genesis for the company. Or you might have milestone-based vesting or something similar. So we can put variations in there. The key thing is that you want to be able to justify those variations, because people sort of start with the assumption that it's got to be 4 years with a 1-year cliff, and so any deviation needs to be explained. So let's talk about acceleration. So what acceleration means is that upon certain specified events, that the vesting of the shares may move more quickly than otherwise. So most vesting is time-based. And so you may have a situation where, let's say the company is acquired, and the employee or the founder's role was dedicated toward getting to that acquisition. Then you might just tell them, okay, you fully vest upon that acquisition only, because your sole role as a more often what we see is what's called double trigger acceleration, which means that if the founder is terminated, or the founder is demoted, or there's some other good reason for the founder to leave, and there's a change of control, then in that scenario, then the founder gets to keep all their shares if they leave. The thinking there is that you don't want the founder to suffer an immense amount of pain and have to continue to go through pain to keep their shares after an acquisition. So double trigger is generally considered to be okay. Single trigger vesting, where it's sort of an either or, a change of control, or a termination without cause, or a termination by the founder because they got demoted or some other good reason. Having only one trigger, a lot of people see that as sort of creating a misalignment between the founder and the company, in that the founder may just choose to stop working. And we see those scenarios, frankly, quite often when you see a single trigger acceleration. And so I try to counsel my clients away from single trigger and toward double trigger. And then one other point related to all of this is what's called an 83B election. Basically, there's a tax code that for founder shares basically allows you to elect to get a favorable tax treatment on the vesting of the shares. The critical component of this is that you need to file that 83B election within 30 days of the grant of the shares by the company. And so, we generally, when we set up the founder shares for these companies, we generally, spend our time making sure we get all the details right. And then, very rapidly, we want to get the shares issued and then the 83B elections filed, because usually for a founding team, it's best to file this 83B election. And if you fail to do so, then there can be some adverse tax consequences down the road. So it's just something to keep in mind. Later employees, I would say it's less clear cut, but for early employees, it's important to get those 83B elections in. And then I'll just touch real quickly on a few other alternatives that we do see from time to time and that we do build into the founder stock packages. First, you might have a what I call control-based founder stock provisions. so you know, the two flavors, they're sort of similar flavors, is you might have a stock that has, you know, a bunch of votes per share, so that a founder has, you know, total control over the company, even if their you know, ownership from a shares perspective is you know, lower. So you see that with like Google has super voting, Facebook has super voting. A lot of our clients ask about getting that super voting in place. And what I would say is it's great in concept for founding teams. It's really hard to justify at the time of your first financing, but maybe can be justified at, you know, after 2 or 3 financings, where it's sort of clear that that the company is on a growth trajectory where the investors will accept that level of control in the founders. And so that's reflected in the sort of a dual class voting stock, which basically says, you know, early owners have class B, late owners have class A, and the class B has, you know, higher amounts of votes than the class A. And so you do see that in some companies as they go public. And then there's also what's called Series FF, or founder preferred founder stock, which basically allows you to, it creates sort of an automatic pre-wired way to sell your shares in connection with a financing round. So for you know, in particular, less established founders where they're you know, they don't have a lot of money, they're living on ramen and they're not paying themselves a salary at the earliest stages, the Series FF allows a founder a clean way to sell some shares in connection with the financing round, get some cash out of selling those shares, and then you know, for the company, it sort of creates a template for that. So because it's pre-baked, it's a little easier to pitch to investors than if you were to just, you know, approach them and tell them, you know, hey, I've got some shares to sell you. So let's talk about meeting expectations. You know, so all of this is you know, to distill it all down. You know, when you work in the world in which I work, you know, with venture-backed companies, it's really critical to sort of set expectations in the right way as among the founders, investors, and the various players in the space. And if there's a mismatch in those expectations, then it's really challenging to deal with that. So you want to make sure that you know, your equity plan looks like others, and that sort of greases the skids for you know, productive conversations with investors. You want to keep it simple. A lot of these things are sort of tried and tested and true. And you know, while I guess from an outsider's perspective, they don't always look simple. From our perspective, they're, you know, on the legal side, we see these structures all the time, and we consider these sort of the most simple. And you know, sticking with the kind of proven model makes things much more efficient over time. And then you know, the last thing I would point out, you know, as we're going to flip to a discussion a little bit about financing models, you want to anticipate dilution from future rounds. So, you know, one thing I haven't talked about is you know, when you issue the shares of stock to the founders, it's a fixed number of shares that you're issuing. And so what that means is that over time, you're going to issue more shares to investors and other employees, and your founders are going to have a relatively smaller slice of the business going forward. And that concept of, you know, the percentage going down over time is called dilution. And it's just an important part of the growth story for most companies. And the way I try to get people to think about it is you're growing a bigger pie over time, and you're going to have a smaller slice of that bigger pie. And so that's that's the best way to think about it is, look, dilution is necessary and you're going to have dilution. But you got to use it in a way that you that's helpful to you and your team. And so that's sort of the critical component, is making sure that you use the dilution to your advantage and minimize dilution to the extent possible. Okay, so let's talk about financing and planning for your seed financing. So, like I said, you want to meet expectations again on financing strategies. The worst thing to spend money on in an early stage financing is having lawyers bat around numerous drafts of documents. So you really want to make sure that you're meeting expectations. You're keeping models simple from a financing perspective, and so there are sort of a few established structures that we've used in early stage financings that tend to work really well. One is just a straight priced equity financing. The second is a convertible note financing, which was a sort of a traditional, easy way to get a deal done. And then the third is I would call it the more modern, standard method, which is an instrument called a SAFE. I'll walk you through each of those in a little bit. Okay, so if you're going to do an equity financing, a priced round, typically what that means is that an investor is coming in at a fixed valuation. They're going to buy shares from the company at a fixed price, but they're going to expect certain things in return for contributing that capital to the business. So these are sort of the primary levers that the investors are going to be talking about. One, they're going to want to have some level of influence on the company's business, meaning a board seat. They'll also want veto rights, and they may also require you to take certain affirmative actions, or they may prohibit you from doing certain actions without their consent. So that can impose, at the earliest stages, you have a lot of flexibility to build the business as you see fit, and then over time, the investors are going to have more and more control over your business. Control over exit rights. So your investors are going to want to have some level of power over your ability to sell the business. They're also going to want to make sure that if they do sell the business, they have the ability to force everyone to go along with that. And so there's what's called a drag along, which forces everyone to vote in favor of certain acquisitions. And then you have the right of first refusal that we talked about previously, and a tag along right that sort of controls what the founder can do. And then you have registration rights, which an investor may use to force an IPO at some point in the future. Ownership and dilution is a key issue for investors. So we talked a little bit about the valuation piece. It's got to be fixed, and they're going to get a defined slice of the business as a result. And then they will also have sort of downside anti-dilution protection. And then on the upside, they'll have a right to invest in your financing round. And then finally, they'll be focused on ensuring that they're just the money, and maybe they'll have a board seat, but they'll be focused on ensuring that they have some ability to keep people motivated, and that's where option grants and the right to repurchase equity upon termination come into play. So that's how all this sort of comes full circle when you get to a financing round, an equity financing round. So just to drill down on the some of the terminology related to a financing round, you'll see a lot of people throw around the terminology valuation or pre-money valuation, post-money valuation. What that fundamentally means is they're going to set a number for the value of your company, either prior or after their investment. Pre-money means before their investment comes in. Post-money means after the dollars of their investment come in. So that's an important point that may be the most critical point to an equity financing. And it also is an important point to the other models that we'll talk about in a sec, the notes and the safe. So all of those have some valuation related factors here, and so understanding how the valuation works is important. The other thing to that goes into the calculus is fully diluted shares. How many shares are outstanding, including the option pool. And so when you down at the bottom, when you're trying to think about, well, how do I think about the ownership that various folks are going to have after a financing, you basically take the valuation divided by the number of shares, and that gets to your pricing of the shares that the investors are buying. The pricing of the shares drives the number of shares that the investors are getting for the amount that they're investing. And then, of course, the number of shares that they receive is going to result in dilution to the founders, either greater or less dilution, depending on, the valuation. So a higher valuation is good for the founders. A lower valuation is bad for the founders. So that's sort of the key thing to think to keep in mind. Some of the other key terms that you see batted around here in equity financing rounds, there's what's called a liquidation preference, which means that if somebody invests and they buy stock, preferred stock, then they're going to get what's called a liquidation preference, meaning if the company is sold, then they get the first dollars out the door. The one thing to note is that it's typically been thought of as a downside protection. In other words, if you wind down the business and you only have $2 million in assets to distribute out to the shareholders and $1 million of liquidation preference, then that means that the investors would generally not lose money in that scenario. But it can also, you see some mature companies now that have, pretty significant amounts of liquidation preference. And so if they're acquired, what that means is their upside can be limited if you have a lot of liquidation preference built into the company. Anti-dilution is a very common concept, almost always in there in a priced round. But effectively what that means is that there's a formula that limits the amount of dilution that the investors will receive in the event that there's a down round financing, meaning the valuation goes down from one financing to the next. The investors will get that, but the founders will not. So just keep that in mind. Anti-dilution protection is only for the investors or the preferred stockholders. Some companies have dividends. I would say that's a more common concept in mature startups or in public companies. And then sometimes you see what are called registration rights, which is where the investors can force the company to go public. And then there's also what's called a redemption right, which is where an investor can force the company to buy back their shares, subject to certain limitations. I would say registration rights are super common. They're in every company. Redemption rights are pretty rare on the West Coast. Rare, but less rare on the East Coast. Some of the control rights, we've talked a little bit about these already. Board voting, the investors will expect to have some level of control over voting. What are called protective provisions, which are the veto rights that certain investors will have. And then a right of first refusal and a right of co-sale, meaning, if the founders seek to, sell their shares, the investors have ways to basically keep their hands tied. So let's talk about convertible notes here. So, the traditional funding models are, you can do equity, you can raise investor equity like we just talked about, or you can raise debt. And traditional debt, like a bank loan, basically says, you're going to get some amount of dollars and you're going to pay it back with interest, and that's it. What we've done in the sort of startup world is what's called a convertible note, which has both debt and equity features. The debt piece basically says, there's going to be a principal amount of the indebtedness. There's going to be a maturity date when a repayment is supposed to be made. And then there will be an interest rate, and either you pay interest as you go, or you pay interest at the very end. And then basically the note holders would have, if the company were to go into bankruptcy, the note holders would be treated as debt holders in a liquidation scenario, which means that the note holders get paid before the investors in the company. The equity related components that you see in convertible notes are kind of interesting. Basically, what it allows you to do is you take the principal and if there's accrued interest, the accrued interest, and you convert it into equity. You convert it into stock at the time of a financing round or certain other triggering events. So what people get most focused on when you talk about convertible notes, and also in safes, which we'll get to, is what's called a qualified financing conversion. And basically what it means is if the company meets certain criteria in raising a financing round, then the note basically automatically converts into that financing round. And it's either going to be converted at a discount to the amount paid by the cash investors, or it might well be converted at a capped valuation that's pre-negotiated at the time the notes are negotiated. So what that means is that the bottom line here is the convertible note allows you to get the cash in the door at the company. You don't need to definitively decide on a final valuation at the time you do the note. You may well decide to put a discount on it, or you may well decide to convert at a specified capped valuation. But it sort of punts the issue of setting a valuation down the road until your financing round. So with that as background, the reality of so what a lot of companies had been doing traditionally is they were raising on convertible notes because they're quicker. You don't have to set a valuation. You don't have to make any filings with the state. You don't need shareholder approvals. So there are a lot of good reasons why you would go with a note over a traditional financing round. But there were some weird aspects to the note that were essentially a carryover from sort of the debt history of convertible notes. First of all, nobody ever repays convertible notes. It's super duper rare. So it's silly to talk about a maturity date on a note when it's exceedingly rare for people to actually pay. Y Combinator and some of the other folks in the Valley came up with this concept of a simple agreement for future equity, or a SAFE is what they call it. And basically what that does is it disposes with the maturity date. It gets rid of the interest rate, and then it gets rid of the sort of debt holder protections that the debtor has, which frankly nobody cares about anyway if they're an angel investor. They can afford, usually the types of investors on a SAFE can afford to lose their money. so that they're not going to worry about, events of default. They don't want to negotiate that stuff. And so it takes away some of those debt-like features. And it's it's super simple. And you'll see the Y Combinator if you just search Y Combinator Safe. They have a model, and it's intended to be used, sort of off the shelf without changes, which is great for founders. I would say, sometimes can be the bane of the existence of the lawyers if each safe is different in terms of the discounts and the caps and whatnot. But there are ways we can deal with that, and I really like the safe for all the advantages that it brings to the table and the simplicity that it brings to the table at a seed stage. So just to recap, here's sort of a summary table of the various instruments that we use in early stage financing. Like I said, I think that the trend is going towards safes. It's simple, tends to be pro-founder, and it doesn't have a lot of the vestigial issues that a convertible note has, but allows you to punt the valuation. So that's pretty much it for my presentation. Just want to recap on a few things here. If you want to get other information, feel free to check out our website, launch.wilmerhale.com. We have a lot of resources for founders in terms of, there's a lot of questions you're going to have at the earliest stages, and so feel free to use our website as a resource, and check it out, and it'll help you with the equity calculator, and then some of the other stuff that you may well want to pull together at the early stages. So with that, I'll pause for questions, and apologies for the technical difficulties early on. But if anyone has any questions, feel free to ask.
That was great, Eric. Thank you so much. Does anybody have any questions? Please submit them to the Q&A box, and we can have Eric address them while we have him on the line. Maybe, let's see. All right, so the first one, Eric, is coming from Ben, who is located in the UK. He's with Small Robot Company, and he's asking if SAFE works internationally.
Yes and no. I would say the concepts will work. If you're in the UK, I think what I can't really speak to is whether the lender protections are different, or whether accounting teams in the UK will treat the safe in the same way they're treated in the US. So I think it's worth bouncing it off your counsel, classic lawyer response. But yeah, so it's worth bouncing it off your counsel. But I think the concepts work, and we do, plenty of people in the UK do convertible note deals, and so I would think that they could understand the safe. It just may not be as prevalent as you see in the United States. So you may have to educate them a little bit and just let them know that it's quite common in the US, and you see it a lot.
Sounds good. The next one is coming from Martha with Egg Tools here in the US, and she said, "Can you repeat about the board positions, meaning the A, B, etc.?"
Sure. Yeah. So the board is, just very high level. Your company is set up so that it has the shareholders elect the members of the board, and then the board members are the ones who hire and fire management and sort of set the strategic tone for the company. And so the board has a lot of power over, who is on the payroll, who is the CEO, and who leads various teams internally, and so who gets to elect those board seats is a really important part of the power dynamics of who has control over the business. And so at the default rule is that basically whoever has the most votes, board is elected just like in any other election, by majority. But in venture-backed companies, what often happens is everyone sort of agrees that you're going to set up a board in a certain way. So at the earliest stages, as among founders, it's usually just a handshake. They all agree, okay, these 2-3 people are going to be on the board. As investors come on, usually each lead investor in any given round is going to want to have a seat on the board. And over time, what that means is that you're going to end up in a situation where the board is majority controlled by the investors. And so as a founder, you're going to want to basically keep your eyes on that, and to the extent that you have the leverage, you continue to control the board as long as possible. So when you get to a financing round, you may well want to structure it in such a way that you have the right to elect, the founders have the right to elect 2 or 3 directors, and the investors may elect 2 or 3 directors. So it's balanced, or you may have a majority. Then to get to I think the part of the question, which was about, Class A, Class B stock. Basically what that means is that you can set up different classes of shareholders such that, the founders who hold a certain, one of the classes, like Class A, they may have, 10 votes for the board members for every 1 vote that the other holders have. And so that's another way, if you don't have an agreement put into place, that's another way to set it up to, guarantee that the founders are going to continue to have the right to control the board just by having more votes. So that's how you solve it for a company like Facebook. Is Mark Zuckerberg just has a different class of shares and he has more votes. But for a private company, pre-IPO, usually you can do it by agreement in a voting agreement.
That's awesome. Thank you. Let's see. We have another question quick. Oh, just Martha. Excellent eye opener. Thank you so much. Tyler also mentioned how great the presentation was. So thank you, Eric, so much for joining us today. If you guys have any other questions, feel free to reach out to him directly, or myself. I can help connect you as well.
All right. Well,
And I
thanks.
think we'll wrap up.
All right.
All right. Thank you so much, everyone. Have a great day.